Hello, how you doing? Stephen Fallon here, Future Proof Finance. Haven't done one of these since 2016, and just seeing as we're coming up to the end of the tax year, I'm going to run another course of these. I'm going to do another 10. Keep them tight, 5 minutes. First one I did the last time was about self-employed people coming up to the end of on the basis of coming up to the end of the tax year. So what I'm going to talk about is a figure that you should work towards in using a tax vehicle or a pension vehicle for retirement. So currently we can take 25% of your pension up to a maximum of 200,000 as a tax-free lump sum. So that's 25% as a tax-free lump sum when you get to retirement. So on the basis of having a fund of 200,000, that's what I believe a modest pension should be. Working out a figure of 200,000, when you get to retirement, you can take 25%, which is 50,000 tax free. The balance, which is 150,000, if you grow that 6% net of charges, so that's your net figure. And you draw that down at 4%. So let's say you draw that down at 4%, that gives you 6,000 on 150,000. So the state pension currently is in around 12,000. So 12,000 and another 6,000, that gives you 18,000 income. From the age of 65, currently you can have income to the tune of, like, this is on the individual, to the age of 60. From age 65 from age 65, you can have income of 18,000 before you pay any tax. So if you take your state pension into account of 12,000 and you've got personal pension income on top of that, that brings you up to the threshold. And if it goes over that, you're going to be paying a very small amount of tax. So let's look at the whole from start to finish on that. So if you save up, as a self-employed person, you save up, you put money in a pension vehicle. If you're on the low rate of tax, you're getting 20% relief on the money going in. You're on the higher rate of tax, you're getting 40%. What that effectively means, for every €100 you put in, if you're on the low rate of tax, you're effectively putting in €80 and you're getting €100 worth of value. If you're on the higher rate, you're putting in 60 and you're getting €100 value for your €60. Okay, so that's your tax relief. At the very start, you've got tax relief down on the growth. So if you work with an advisor and you get sort of a consistent manageable growth down through the years, you'll get your tax relief on the money going in, tax relief on the growth. Then when you get to retirement, you take your tax-free lump sum, which is your 50,000, and then your 150,000 still comes in under the threshold. So effectively, you've used the tax-efficient vehicle to its maximum capacity. You can't get any more tax-efficient than that. It makes perfect sense to do this. Now, people coming up to the end of the tax year, talk to your accountant. Find out what he's suggesting as an amount to put in. If you're not putting it into the pension as a self-employed person, that your accountant might be telling you to keep your tax down and to spend it on tools and vehicles and all that. All that stuff, it won't serve you when you're coming to retire. So if you actually put a little bit more money away for retirement, deferred gratification, instead of having the newest van or the shiniest tools or all of that sort of stuff, focus on deferred gratification, kind of preventative medicine. Put the money away so that when you're no longer working, you've got income from the proceeds of the work you've done. Basically what you're doing is, let's use a 20-year example. You're basically planting seeds that you can harvest when it comes to retirement. So you'll get the fruit of stuff you've planted 20 years beforehand. And you think, when's the best time to plant a tree? It was 20 years ago. So think of your pension as in, when was the best time to put the pension away? 20 years ago. So, okay, I'll talk to you again in due course, and I'll do a series of these, and on each one I'll have a kind of a different flavor to it. Okay, take care. Bye-bye.